Welcome to the deep dive. So today we're taking a closer look, really getting under the hood, of a major global industrial player, Mitsubishi Heavy Industries Group, MHI.
Yeah, and our main source here is their own 2024 integrated report. So it's straight from the horse's mouth, you could say. Gives us a pretty detailed view of their strategy, their finances.
Exactly, it's like their roadmap. And our mission really is to pull out the key stuff. What are their main businesses doing? How are the financials looking? And what are their plans for growth and keeping shareholders happy?
Right. Cut through the detail and get to the core insights. Give you a clear picture of where MHI is and where it seems to be heading.
Okay, so the starting point seems to be this 2024 medium-term business plan, the 2024 MTBP, announced back in May.
That's the one. And it's important to know it's not starting from scratch. It actually builds quite directly on their previous plan, the 2021 MTBP.
Ah, okay. And that one was put together during, well, pretty uncertain times, right? Mid-pandemic.
Exactly. So the focus back then, understandably, was less about just raw expansion and more about shoring things up, strengthening profitability, making the whole operation more resilient.
Did that work out?
It seems so, yeah. The report highlights that they hit record highs for orders, revenue, and business profit in the last fiscal year, FY 2023. So that focus on, let's say, quality over just quantity appears to have paid off.
Makes sense. So now that they've kind of weathered that storm, what's the big theme for this new plan, the 2024 MTBP?
The main banner, if you like, is strengthen portfolio management.
Okay. What does that mean in practice?
Well, basically, it's about looking really closely at all the different parts of their business, figuring out which ones have the best potential, and then making sure they're putting their resources, people where they can get the biggest bang for their buck for the whole group.
Got it. So being strategic about where they focus.
Precisely. And they break that down into three key focus areas within the plan.
All right, what are they?
First, keep the momentum going in their core businesses that are already growing well. Second, take those sort of future bets they identified back in the 2021 plan and push them towards becoming actual commercial realities.
Okay, future bets becoming real businesses.
Yeah. And third, just generally making all their businesses more competitive, sharpening their edge.
Let's dig into that first one, the growing core businesses. The report mentions some big numbers, like aiming for an extra trillion yen in revenue by FY 2026 from areas like gas turbines, nuclear, and defense. What's driving that?
A big part of it is just fulfilling the orders they already booked during the last plan. They had a really strong order intake in those areas.
So converting those orders into actual revenue now.
Exactly.
Yeah.
But it's also that these specific areas, energy transition, smart infrastructure, aircraft defense, and space, are tapping into some pretty major global shifts.
Yeah.
Think cleaner energy, national security. These are big trends.
Right. Let me take energy transition as an example. What are they doing there?
Well, within energy transition, there's a strong focus on balancing stable energy supply with security needs. Take their gas turbine combined cycle or GTCC business. They're really proud of their JC series turbines.
I saw that mentioned, high efficiency.
Extremely high. They quote 64% efficiency, which is pretty much world leading. And they've got a lot of operational hours logged on these already, over 2.4 million hours across, I think, 136 units booked by mid last year.
And that efficiency translates to lower emissions compared to older tech.
Significantly lower, yeah. Up to 65% less CO2 compared to, say, traditional coal plants. And they're not stopping there. They're actively developing turbines that can run on 100% hydrogen.
Wow, okay. The future fuel.
Well, aiming for it. Commercialization for that is planned for 2030 or later.
Yeah.
And also ammonia-fired turbines with a 40 milliW Class 1 potentially launching commercially around 2025. Plus, collaborations on CO2 capture tech with big names like Kansai Electric Power and ExxonMobil.
So, tackling emissions from multiple angles, what about nuclear power? That seems to be having a bit of a resurgence in interest globally.
It does, and MHI seems well placed. Their plan involves supporting the restart of existing plants in Japan, both PWR and BWR types, building storage facilities for spent fuel, doing maintenance, and even looking at exporting equipment.
So supporting the current infrastructure and looking outwards.
Yes, and also developing new stuff. They're designing an advanced light water reactor, the SRZ 1200, and working on next-gen concepts like fast reactors and high-temperature gas-cooled reactors. They've actually been picked as a core company for Japanese demonstration projects in those advanced areas.
That sounds like a pretty deep commitment to nuclear.
It definitely signals they see a long-term role for it.
Okay, then the third big core area mentioned was defense. The report says it's expanding rapidly.
Yeah, that aligns with, well, global trends and specifically increased national security focus in Japan.
Yeah.
MHI is involved in a lot of key areas. Things like standoff defense capabilities, basically, being able to engage targets from further away. Also, integrated missile defense, which is obviously a hot topic. They're part of the big international project, the Global Combat Air Program, for the next-gen fighter jet.
GCA? Right.
That's the one.
Mm-hmm.
And also unmanned systems, aerial, underwater, ground vehicles, plus using space assets for defense. It's pretty broad.
And they're scaling up to meet this demand.
Significantly. Planning to increase personnel in that area by around 30% and boost their R&D and production capacity.
Okay, so those are the core growth engines.
Right.
What about the second pillar, commercializing future growth areas? What does that involve?
These are the technologies they've been nurturing, aiming for full-scale business deployment, probably starting with the next MTBP around 2027. Things like CO2 capture systems, not just the process, but the actual absorbent materials too.
So the whole package.
Exactly. Or offering like one-stop decarbonization solutions for big industrial customers, combining energy supply, cooling, smart management systems.
Integrated solutions.
Right. And their acquisition of Concentric, LLC in the U.S. last year, fits here too. That gets them deeper into electrification and, crucially, power systems for data centers.
Ah, data centers, yeah. Huge energy consumers.
Massive. So providing efficient, maybe even decarbonized power solutions there is a big potential market.
And the third pillar was enhancing competitiveness. How are they approaching that?
It's about staying sharp, expanding where it makes sense, grabbing more market share, but also being pragmatic. Like, they acknowledge demand for new coal-fired power plants is declining.
Understandably.
Right. So that's chasing that. They're focusing on supporting the customers who already operate their coal plants.
Yeah.
It's also about maybe finding new ways to make money from their tech, like through licensing, especially in that whole energy transition space.
Okay, that gives us a really good sense of the strategic direction. Let's pivot to the financials now. The 2024 MTBP sets some hard targets, doesn't it?
It does. Pretty ambitious ones. By fiscal 2026, they're targeting revenue of 5.7 trillion yen or more.
Wow.
A business profit of at least 450 billion yen. And return on equity, ROE, hitting 12% or higher.
And that ROE figure, just to remind folks, that's about how effectively they use shareholder investments to make profit, right?
Exactly. It's a key measure of profitability from the shareholder perspective.
How do these targets stack up against how they did recently? You mentioned FY 2023 was a record year.
It was. Record orders, revenue, and profit. And a big reason cited was that strategic shift during the 2021 plan, prioritizing profit margins over just chasing sales volume. That discipline seems to have built a strong foundation.
So they're building from a position of strength. What about cash? Where's the money coming from, and where's it going under this new plan?
Over the 3 years of the plan, they're forecasting total cash inflows of about 1.51 trillion yen.
Okay.
Most of that, around 1.4 trillion, is expected just from their regular operations, their operating cash flow. Smaller chunk, maybe 110 billion, from things like selling off assets.
And the plan for spending that cash?
It's clearly laid out. A big slice, 650 billion yen, is going straight back into investing in those growing core businesses and the future growth areas we talked about.
Feeding the growth engines.
Right. They also mentioned setting aside a significant amount for potential business acquisitions to supplement that growth. And crucially for investors, a portion is dedicated to shareholder returns.
Now, you mentioned profitability targets. The report also talks about boosting profits without necessarily just growing the size of the company's assets overall. How do they plan to do that?
Yeah, that's about efficiency. Getting more out of what they already have. They're focusing on things like speeding up production times, managing inventory better so less cash is tied up, improving payment terms with suppliers and customers.
Operational improvements?
Exactly. And the finance teams are apparently taking a lead role in pushing this asset efficiency drive. The goal is to lift their business profit margin from 6% in FY 2023 to 8% or more by FY 2026.
And that ties into the ROE target, too.
It does. Getting that ROE from 11% last year up to 12% or more relies heavily on this kind of efficiency gain, making the assets work harder.
The report included a balance sheet snapshot from March 2023. Anything jump out there?
Well, the headline figures were total assets around 5.5 trillion yen, total equity about 1.8 trillion, and interest-bearing debt around 740 billion yen. One thing noted was an increase in inventory.
Tied to that efficiency drive, perhaps? Or maybe stocking up?
Could be strategic stocking, yeah. And also an increase in assets held in foreign currencies, largely because the yen had weakened quite a bit.
Yeah.
Just factors to be aware of that influence the numbers.
Okay. Now let's talk shareholder value directly. Dividends are obviously key for many investors. What's changing there?
This is quite a significant shift in the 2024 plan. They're moving to a new primary metric for dividends, the dividend on equity, or
Yeah.
DOE ratio.
TOE, okay.
Yeah.
How does that work?
Instead of tying dividends primarily to the year's net income, which can bounce around, DOE links the dividend payout more directly to the company's total equity. The aim is to provide more stable and steadily increasing dividends over time.
So more predictability for investors.
That seems to be the goal. They know their cost of equity is roughly 8%, so they've set a DOE target of 4% or higher, essentially aiming to consistently return over half of their capital costs back to shareholders via dividends.
And what does that mean in actual yen per share?
For this fiscal year, FY 2024, they've planned a dividend of 22 yen per share. That's up 2 yen from last year. And looking out to FY 2026, the end of the plan, they're targeting 26 yen per share, so a clear upward trajectory.
You mentioned shareholder returns as a use of cash flow earlier. Does that include share buybacks as well?
The report doesn't seem to specify exact amounts for buybacks in this plan, but yes, shareholder returns are listed as a category for cash allocation. So buybacks are definitely still on the table as a tool they can use, alongside investing in the business and managing debt. They'll likely decide based on market conditions and their capital needs at the time.
Right, maintaining flexibility. There was also that stock split earlier this year, 10 for 1. What was the thinking there?
Yeah, that happened April 1st. The main idea was simply to lower the price of a single trading unit of MHI stock. Makes it easier for smaller, individual retail investors to buy shares.
So broadening the investor base.
Exactly. Trying to attract more people to invest in the company.
It all seems to tie together grow the business, improve efficiency, and make the stock appealing through dividends and accessibility.
That's the picture they're painting. They're quite explicit that delivering solid results is key to boosting the stock price and being seen as, an indispensable growing company. There's even this best owner concept they mentioned regarding their portfolio. It basically means they'll evaluate if MHI is truly the best company to own a particular business unit. If someone else could potentially create more value with it, they might consider selling it, even if it's profitable for MHI. It's about maximizing the overall corporate value.
That's quite a disciplined, maybe even unsentimental approach.
It suggests a very strategic mindset, yeah. Focused on the bigger picture.
Okay, so wrapping things up, if you had to give an overall assessment of MHI based on this report, what would you say? Where are they heading?
Well, first off, they seem to have built a really solid foundation during the last plan, despite the challenges. Those record results for FY 2023 are proof of that.
Right.
Now, this 2024 plan set some pretty ambitious targets, but they seem grounded in a clear strategy. They're focusing on core areas like energy transition and defense. They're clearly aligned with huge global needs and spending trends.
So good strategic positioning.
I think so. And they're not just resting there. They're actively trying to commercialize those future technologies and constantly improve competitiveness. Financially, the emphasis on discipline, on getting more profit out of existing assets.
The efficiency drive.
Exactly, that's crucial. And the new dividend policy, the DOE approach, signals a stronger commitment to predictable shareholder returns. Plus, the stock split helps with accessibility. It feels like a coherent package.
Any potential watchouts or risks?
Well, like any huge industrial company, they face execution risks on big projects, global economic shifts, supply chain issues. The report does detail their risk management processes, but those external factors are always present. And successfully commercializing things like hydrogen turbines or advanced nuclear reactors takes time and significant investment.
Sure, there are always hurdles, but overall the plan seems quite comprehensive.
It does. They're clearly trying to leverage their technological strengths to navigate these major global shifts towards sustainability and security, while keeping a firm grip on the financials and shareholder value.
So to kind of summarize this deep dive into MHI's 2024 report, they're really zeroing in on these high growth areas tied to global trends, right? Energy security.
Definitely.
Okay.
While also pushing hard on financial discipline and efficiency. And they've made shareholder returns more explicit and potentially more predictable with the new dividend policy and the stock split.
It's a clear statement of intent.
It is. And it leaves us with something interesting for you, the listener, to think about. How does the strategic shift we see at MHI, really leaning into energy transition and defense, reflect those bigger global priorities we've talked about?
Mm.
And what might that mean for the future of these kinds of massive, diversified industrial companies? Are we seeing a template here? What other big established industries might be facing similar fundamental transformations right now?
Yeah, definitely some food for thought there. What does it mean to be an industrial giant in the 21st century?
Good question.
All right, that brings us to the end of this deep dive. Thanks for joining us. We'll catch you on the next one.